Just to give you some idea of my background, I was a modern dancer for many years, for about 20 years here in New York. I danced with companies like Lucinda Childs, Rachel Lampert, Mimi Gerard. Because modern dancers are not some of the higher paid professional artists in the city, I was always looking for ways of making extra money to kind of make ends meet. I landed at this Wall Street company, which specialized in shareholder meetings and hostile proxy fights and tender offers, all of which I knew absolutely nothing about. But I learned while I was there. This was also around the same time that mutual funds were starting to become very accessible to regular people. So it was when there was actually an opportunity for regular people to start investing in the market. So I started having a lot of friends who were in the arts call me and say, look, we know you work on Wall Street, so you're starting to figure out what some of this stuff means. We'd really like to get in on this and start investing, but we're kind of embarrassed to call these companies because we don't really know what we're talking about and we don't have that much money, and it makes us uncomfortable to call them. So do you mind if we start asking you some questions? This led us to form a group called the Thriving Artists Investment Club. So there were about 9 of us that started it. We met once a month. The main purpose of the investment club was to educate ourselves about the financial markets and how we could invest in them. We put in very minimal dues because we wanted to make sure nobody ever felt overly stressed. So we put $25 a month in. By the time we disbanded, it was about 9 years later. Each of us that had been there from the beginning ended up putting in about $2,800. We cashed out just over $4,300 each, which is a pretty significant return for a bunch of artists who aren't really supposed to understand anything about finances, right? But it got me to thinking about that there are many of the assets that we have and the attributes we have as artists actually makes us very good at working in the financial markets. It's just a matter of figuring out how to apply them to it. And one of the biggest obstacles I think we always have is that the financial information that's out there isn't geared towards the lifestyle that we find ourselves living. It's for the people who are working 9 to 5, are getting a 401k, can't wait to retire, and then go off and do whatever it is that they want to do. That wasn't my experience, and that's probably not a lot of your experiences either. So in looking at this financial information that's out there, the first thing we have to do is understand what the heck they're talking about, right? Because it's like hearing a different language. Then once we understand it, we have to figure out how to apply it to what's happening in our own lives, all right? Why do you think it would be helpful to take control of your finances as an artist? What do you think it would do for you? Anybody have any ideas? Peace of mind. That's a big one, right? Wouldn't it be a relief to go, I don't have to worry about money anymore, right? Or at least to say I don't have to worry as much about money anymore. That's an important one. Anything else? Choice. That is one of the biggest ones, and I'm so happy that somebody said that because most people never think of that the taking control of your finances is going to give you choice in what you do as an artist. My story of choice, which I like to use to illustrate this, is back in my dance days, I was called in to audition to be the tap dancing bumblebee for Macy's flower show. Okay? So I get into this audition with a bunch of men in suits, because all the Macy's executives were there. They had me put on a bumblebee costume, including like a hat with the little antennas, my tap shoes, and then they said, could you please talk in a bee voice, David, and tell bee jokes and do a little dance, and we'll see how you do. I didn't get it. It was pre-YouTube, so there's no footage out there, thank goodness. But the fact that I didn't have to do that, because for me, I was a modern dancer. And I'm not saying there's anything wrong with people dressing up in bee costumes and making money being a tap dancing bumblebee. Kind of wasn't my thing. As a modern dancer, I was often able to choose to do projects that meant something to me, that were really important to me without having to worry about how much money I was making, because I had sort of taken care of that other element of my life. So that's a really important one, and often one that people overlook. Some of the other things to think about is that it would give you some stability, right? You don't have to necessarily think, what am I going to do for next month's rent, right? It's going to be sort of taken care of. It will give you a little bit more stability. And knowledge. which is also an important one. You don't have to feel uncomfortable about what's happening with your finances. Even if you choose to work with someone as a financial advisor, if you're knowledgeable about what they're talking about, it's going to make you feel a lot less uncomfortable and make you feel more empowered to do things for yourself. I always like to throw in a myth buster that's sort of related to the topic. So the myth buster for tonight is that you need to have a lot of money before you could start investing. How many of you have always felt that way? That until you have a bunch of money, exactly, what's the point, right? And what does that make you do? It makes you procrastinate and say, well, I don't have to do anything then, right? Because I have to wait until I have a ton of money. One of the things we're going to erase tonight is that idea that you have to have a lot of money. And we're going to, when we start talking about these assets that you can invest in that will start to build a revenue stream for you to use, we'll talk about some ways that you can get into them with very little amounts of money, doing it consistently, because that's important. So I hate to really take this crutch away from you, but I just did, okay? That's not an excuse anymore. Get rid of it. As I mentioned, a lot of the strengths that you already have as artists are very applicable to the work that you're going to do in building your finances and creating financial security for yourself. One is your creativity. I mean, that's what we do as artists, right? We're taught to learn how to think differently than everybody else and find creative solutions to problems that are in front of us. The same is true of investing. If there was one formula that I could give you that said, if you do this, this, and this, and this, and this, you're going to be independently wealthy, everybody in the world would be following it and you'd be wealthy, right? There isn't one. And there's also a different path that everybody needs to take depending on their own circumstances. Because you're used to coming up with already with creative solutions to things, that's going to work to your favor because you can look at the problem and you can find different ways of addressing it. So use that. Kind of hand in hand with that is your counterintuition. Have you ever heard of the herd mentality? When you think of Wall Street, I like to think of them more, rather than a herd, like lemmings that are like kind of going off the cliff, right? Whereas the artist in the group would be kind of going, yeah, maybe that's not such a smart idea. Maybe I'll go the other way. Yeah, that will serve you very well. And a good example that I have of that is that back in the financial crisis that happened back in like 2007, all of the bank stocks and other financial stocks around the globe plummeted because of all the problems that were happening in the financial markets. In many cases, that was appropriate because the financial institutions were in terrible shape and had taken incredible risks that they were paying for, right? But there were certain financial institutions, like the banks in Canada and the banks in Australia, that hadn't done that, but the value of their stock plummeted along with everybody else because they were caught up in that hype of the financial markets are going down the tube, we have to dump all of our financial investments. So if at that time you had been counterintuitive enough to say, well, wait a minute, some of these, yes, they should be going pear-shaped, but some of them are and don't have any reason to be, and you had gone in and bought some of those assets, you would have done really well. So use that counterintuition to your benefit. Persistence. I think there's probably not a word that defines artists better than persistence, right? I never thought I could go into a single dance class and suddenly be in a professional company, right? I don't think any of you have the illusion that you would take an acting class and get a leading role in a Hollywood blockbuster, or take one speech class and become a major voiceover artist, right? We understand that it takes a lot of hard work, daily work, and the accumulated result of putting in that work on a day-to-day basis gets you where you need to be, right? Honestly, if I had $1 for every tendu that I had to do in my career, I would own Tahiti right now. I would have sent a plane to take us all there so we could be sitting on the beach to have this discussion there, right? That's not reality. We know you have to do that to get to where you need to go. The same is true of your finances. Don't think of your financial well-being so much as like the slot machine that you hope that you hit the jackpot and then it'll all, but if you don't, it's okay. Think of it as putting these building blocks together that's going to create a solid foundation that over the long term is going to support what you do. Yeah? Finally, I also like to put in a habit du jour. So the habit that I would like you to adopt, because it's always important to find habits to sort of bring into your life, is to start to save. And as you start off on your exploration of your financial well-being, starting to save is one of the most important things you can do. Even if you can only start to save $5 a month, the important thing is to establish that as a habit, okay? Once you realize that $5 a month isn't so difficult to save, start increasing it to $6 or to $10. This is the money we're gonna be starting to use to build a financial portfolio and start to invest in assets that are gonna start to help you, okay? What you don't wanna do is go out of here and say, I'm all set, I'm gonna start saving $2,000 a month every month. Okay? Because what's gonna happen is after like a month or two, you're gonna go, I feel really deprived. I hate this, I hate David, I don't ever wanna do this again. And then you're gonna stop doing it, okay? So make it a goal that you can achieve and that you're not gonna notice so much, and then start to increase it so that you can consistently do it. Just like we were talking about your persistence with your craft, if you consistently save, it's going to work to your benefit. Let's talk about some ways that you can start to save if you're not already doing so. These are just some tricks that I've learned from people over the time. Corral your change. So I know some people that at the end of every day, whatever change, the first question I have is, how many of you don't ever use cash? That only use credit cards? Yeah, I'm always stunned that happens now. Yeah, so for those of us who still use cash, at the end of the day, I use cash. I use credit cards too, but I use cash. They take any change that they get during the course of the day and they throw it into a jar. And then periodically they dump that into the bank, okay? That's one way you can sort of save. Saving your bills is another way. I don't mean don't pay your Con Ed bills so that you go, wow, I saved $100, and then they shut off your electricity. That's not what I'm talking about. I had a friend who saved $5 bills. So anytime she would get change as a $5 bill, she would put that away and then put that in the bank. So that was another trick to sort of make herself save, okay? Automatic transfers are an incredible habit to get into and an incredible way to save. And we're also gonna talk about how these can work with some of these other assets that we're gonna be building for income. What that means is that you go into like your bank account or whatever account that you generally get your income into, and you set up a monthly transfer of $20, $50, $100, whatever you think you can afford, into either a savings account there, or even better, an account that's not even at the same institution, that's somewhere else where it's more difficult to get your hands on it. By setting it up every month, you don't have to think about it. You don't run the risk of those months where you go, ooh, maybe I should have saved, or maybe I don't want to do it this month. It becomes like paying a bill. And then you'll be amazed at how fast your assets can start to accrue when you do that. And again, with that automatic monthly transfer, don't make it unrealistic at first. Start with a small amount that you're not really going to notice that much. Keep it going so that you can keep it going, and then increase it as you can. Do without days is another fun one. So for those of you who I'm not a Starbucks drinker, but for those of you that get the mocha frappuccino, whatever is out there, how much do those cost now? Does anybody have a sense of? Like $4 or $5, right? For a grande or a whatever. For a small one, $6 for a grande? Okay. So if you take one day that you do without your mocha frappuccino grande, that's $6 that you can save and you put in the bank. So and then you could either go to like the local deli where it costs $1, or you could get a thermos and make your own coffee and take it in that day, or something like that. Try to find a do without day. Look at your expenses and see, what am I spending my money on all the time? Where is most of my disposable income going? Let's put it into that. When we talk about building a portfolio for your financial well-being, I always talk about having 3 asset types that you put into that. The key to this portfolio, your asset portfolio, is to be diversified in what you're investing in. And there's 2 main reasons for that. The first reason for diversification is that you mitigate your risk, right? If you put all your eggs into one basket and that goes bankrupt, you're in trouble, right? You've lost everything. If you diversify into different assets, then if something happens to one, you have others to counterbalance that. The second thing is, all of these assets tend to fluctuate on the market. They have their up periods and they have their down periods. Different types of assets don't follow the same pattern in that. So by being diversified, at the moment when some of your assets may be increasing tremendously in value, they're going to be offsetting the ones that may be in their sort of downward part of their arc, and vice versa. So you want to diversify both to mitigate your risk and also to make sure that you're taking advantage of the ups and downs in the market across many different assets. The first thing, what I like to talk about, sort of the base of the triangle, is cash, the cash portion of your investments, which basically makes up your emergency reserves, okay? What are some types of cash investments that you have? You probably all have at least 2 or 3 of them. Can you think of any? No, stocks, CDs, certificates of deposit that you can get, savings account at a bank, yep. Checking account, an IRA, no, an IRA is a type of retirement vehicle that you could have a cash investment in, but that's a tax kind of structure that you put things into. So we have savings accounts, checking accounts, certificates of deposit, money market. Those are the 4 main types of cash accounts. What makes those all considered to be cash investments, those 4? They're liquid, yes, but if you talk about assets that you have in a money market account, those are liquid too, because you could take them out even if they're not necessarily cash, right? There's another key tenet. If you went to a bank tomorrow and you put $100 into a savings account, all right? And you went back a year from now and you said to the teller, I want to take my $100 out of my bank account. Would the teller say to you, well, based on the trading value of the dollar, that's now only worth $96? No, they're going to give you $100 back, right? The premise is a dollar equals a dollar. That's what makes those cash vehicles. Now, against foreign currencies, that's not true. But within the United States, the value of the dollar itself, the dollar unit, doesn't fluctuate on the market. That also doesn't mean that 10 years from now, inflation won't cause the buying power of that to have changed. But 10 years from now, even if you can't buy as much with it, it's still $100, right? So that's what makes cash super safe. That also means, have you looked at the interest that you're getting from your banks? They don't give you very much because it's super safe and they can't make anything on it, right? So I like to think of that as the bedrock, or also as the ballast in your ship. That's what's sort of holding the safety in your portfolio. As I said, you use that for your emergency cash reserves. You should figure out what I like to call your monthly nut, which is how much it costs you to live on in any given month. Usually, typically for regular people, they say you want to have 4 to 6 months of your monthly nut in cash. I say regular people a lot. Everybody here is an artist, right? So you're not going to get offended when I call them regular people. I was on a panel here once, and the person was from the business, and I said it, and then I realized that maybe I shouldn't have said it that way. But anyway, he was fine. He didn't hit me. So for us, I usually say you want to have 8 to 12 months in cash on reserve. Now, 2 things with that, and you go, oh my gosh, right? Does that mean I want all of you to call me tomorrow and say, I have my 12 months of cash? No, that's the goal that you're working towards, okay? You don't want to wait to have all of your emergency cash funds in place before you start investing in other types of assets. Because as we know, cash isn't going to make you very much money, right? These other assets are going to build, even though they have more risk, they're going to give you much more return. So you want to be investing at those at the same time. Generally, I say to people, if you have 0 cash reserves right now, you want to at least have 1 or 2 months under your belt before you start investing in other types of assets. That's because with fluctuating income, you may need to be dipping into those to get you through months where you don't have as much money coming in, right? Once you have 1 to 2 months under your belt that you have stored in your savings account, then start to build both simultaneously, the other elements of your portfolio as well as the rest of your cash stash, so that at some point down the line, you'll hopefully have 8 to 12 months of cash plus all these other assets that are working to help you, yeah? And imagine if you get to the point where you have a whole year's worth of emergency cash, that's a lot of peace of mind, right? To know that you didn't really have to work for a year and you'd be okay. Next up, we have bonds. So cash, the premise of cash investments was $1 equals $1. What do you think a bond is? Any ideas? Debt. It's debt, which means it's a loan, right? Whoops. It's a loan. You're loaning money to someone, they're agreeing to pay it back to you after a certain period of time, and they're agreeing to pay you a certain rate of interest on top of that, okay? That makes bonds a little bit riskier than just cash, right? Because there's always a chance that they're not gonna pay you back, right? There's also a chance that the interest rate they're agreeing to pay you over the period of time that your money's locked up, if there's really high inflation, that the inflation may supersede the amount of interest that you're being paid on it. So there's a little bit more risk depending on how long the bond is for. So because of that, it tends to pay out a little bit more, a better return, right? You'll notice I titled this fixed income, right? That's clue number one, that's gonna be a big topic we're gonna talk about on an asset that can throw off income that can help you, okay? Bonds are a big part of that, and we'll talk about that in much more depth. Next up are, and the final part of this sort of trio that makes up what I call the core portfolio is stock. So what is a stock? Ownership. You own the company. You're an owner, right? As an owner, you take the risks of the company doing well or the company doing poorly, right? Stocks are the most volatile. They're at the highest end of the range of our portfolio. Which means they also have the greatest potential for return, okay? And we're gonna talk about an element of that also as we're talking about ways that we can have assets that are gonna create some revenue. The main, as I said, the main income-producing assets we're gonna be discussing today are, and by the way, this core portfolio, we just talked about the cash, bonds, and stock. There are obviously other types of investments you can have outside of that. I look at those as being the core. Once you have a strong core, you can add other riskier types of investments to it. Generally, what you don't want to do is if you have nothing, go for the riskiest first, because then then you're going to just, for me, who doesn't really like a whole lot of risk, you go crazy watching it go all over the map, right? So bonds, we're going to talk about dividend stocks. Remember I talked about stocks in general being very volatile. Dividend stocks are a subset of the stock group. So not all stocks pay dividends. The ones we're talking about are those that pay dividends. And finally, real estate. One income-producing asset that I'm not going to be talking about tonight are annuities. And the reason I'm not is because I really wanted to focus on assets that you can invest in with very small amounts of money and start building positions in. And with annuities, typically you need a chunk of money to put into it in order to get that out, okay? Now, some of you may be looking and saying, well, real estate, hello? I mean, you can't buy a house for $100, right, or an apartment. We'll find out how we can get into real estate with very small amounts of money, all right? Two premises that I want to talk about just to sort of make sure that you have an understanding of it, because they will come in, they will start helping us as we start investing in these income producing. The first is compounding. Have you all heard the term compounding? Yeah. Does anybody know what it is?
Interest on your interest.
Interest on your interest, right. Basically it means as your assets generate revenue, and that revenue gets reinvested, you have more to generate revenue from. So I like to use the image of the snowball rolling down the hill, right? The farther it goes down the hill, the bigger it gets, the more snow it can pick up, the bigger it gets, et cetera, et cetera. So the more time you have from the time you invest, the more time your assets have to start compounding, which is why it's really important to start early as you can. And that's, again, another reason to not have this idea that you have to have a lot of money in order to start investing. If you start investing small amounts, they'll start working for you as well, and that's what you really want. I love this picture because you'll notice at the beginning, it looks like it's sort of incrementally growing, but then as you get further along, it starts becoming more and more, right? That's because compounding has a geometric progression, like the snowball. The further it goes, the bigger it gets, right? So that's an important element of what we're going to be talking about. I'll give you, when we start talking about dividend stocks, I'll give you a more specific example of how compounding works. The other kind of concept is dollar cost averaging, okay? And what that means is if you are in the habit of putting small amounts of money into your asset at regular intervals, right? And or have your interest or dividends reinvested, over time, the cost of your asset tends to even out, right? So it means if you're putting, let's say you're putting $100 a month in to an asset every month, okay? In the months that the asset is very expensive, you're gonna be buying fewer shares of it, right? In the months that it's lower in price, you're gonna be buying more, which means over time it evens out, right? If we could time the market and say, I'm gonna put my money, all my money into the market at the time when it's at the absolute lowest, that would be great, but that's virtually impossible to do, right? Conversely, if you put all your money in and it happens to be at the highest time and then there's a plummet, you could lose a lot, right? So this idea of putting in money at regular intervals consistently, which also means reinvesting the dividends, which get reinvested consistently, averages out the price you pay for the assets, which also mitigates some risk for you, right? Does that make sense? Is everybody okay so far? I also want to talk about some vehicles that make it easier to become diversified in many of these asset types. And we're just going to talk really generally about them. You can certainly feel free at the end to ask more specific questions on them, but I just want you to have an idea of what these sort of types, the investment types are. So a mutual fund, many of you have probably heard of mutual funds. Basically, it's a basket in which they've put a bunch of different assets. Okay, and you're buying a share of that grouping of assets, okay? Which means that you're instantly diversifying, right? Because you're getting everything that's in that basket of the mutual fund. The way they price them, so when you buy mutual fund shares, you're buying them from the mutual fund company itself. So when you want to buy shares, they're issuing shares to you. When you want to redeem them, you're selling your shares back to the mutual fund itself, and they're giving you your money back for it, okay? The way they're priced is they only price them once at the end of every day. So at the end of every trading day, they look at what the value is of every asset that's within that particular mutual fund. They add it all up, they divide it by the total number of shares that are outstanding for that mutual fund, and that becomes the net asset value of the shares of the mutual fund, which is abbreviated as NAV, okay? This is an important distinction between the exchange-traded funds, which we're going to talk about in a second. So mutual funds are priced only once a day at the end of the day, and it's based on the value of the assets in the mutual fund at the end of that trading day. Some of the charges that you can experience when you buy mutual funds are typically known as loads. Basically, think of them as sales charges. A front-end load is if you pay a charge when you buy the shares of the mutual fund. Back-end load is when you sell the shares of the mutual fund. You can get charged for that. No load means you don't pay a charge either buying or selling. Which do you think I'm going to tell you to look for? No load, right? You always want to avoid fees because it's better to have the money in your own pocket than in their pocket, okay? So there's tons of no-load mutual funds out there. So always you want to look, when you start looking into mutual funds, try to find no-load ones, okay? Because you don't want to be paying a fee for that. The other thing you want to look for in terms of charges is the expense ratio. And that basically means what percentage of the assets in the mutual fund they're using for various expenses of the mutual fund, right? They have to hire people to manage the fund. They have to hire analysts to look at what are in the fund. They have to, hire people to make the statements for the people that are, running the fund and for the investors in the fund. They have to do advertising. There's a lot of expenses that are associated with that. That expense ratio is something that they must publish. They must tell you what the expense ratio is, and you always want to try to find ones that have very low expense ratios. So when you're looking at mutual funds, you might see two that you're sort of comparing that you're interested in. One of the things you want to look at is an expense ratio, because if you find one that has an expense ratio of 1.2% and you have another that has an expense ratio of 0.6%, and they both have similar assets, you want to go with the one with the lower expense ratio, because that means, again, more money's going into your own pocket. You're keeping more of it yourself, okay? Exchange-traded funds are the other kind of sort of way you can get into owning a group of stocks. They're commonly known as ETFs. Their structure is similar to a mutual fund in that it's a collection of assets within the fund itself. One of the big differences is as we said, with mutual funds, when you buy the shares, the fund itself issues the shares to you. When you want your money back, you sell it back to them. With exchange-traded funds, they actually issue the shares on the market. So they trade like a stock. So you have ETFs trading out there like shares of stock on the market, okay? So in order to buy them, you have to buy them from a broker, just like you would buy a regular stock, okay? That means that the price of an ETF fluctuates throughout the day just like the price of a stock would. So where a mutual fund is only priced once at the end of the day, ETFs trade throughout the day. So you can buy them at different prices, okay? So that's a key difference between the two of them. We did pricing. The fees, they tend to have very low fees for ETFs because once they're issued, there isn't a lot of changes that are made to the underlying portfolio. But remember that often you do have to pay a commission to your broker for buying and selling them. So that's another way that a fee can get tacked onto it. So let's talk about bonds and how bonds, these fixed income instruments, can be used to help generate some income for you. So there's three basic types of bonds that are out there. There's US Treasury bonds, municipal bonds, and corporate bonds. Those are the three kind of broad categories, okay? US government bonds are bonds that are issued by the United States Treasury and are guaranteed by it, which makes them safer than cash, even though these days we might think that there's a risk that the US Treasury might not be able to pay us back, but we hope that that doesn't happen, because if that happens, that would be really terrible. It did happen to Argentina. Many years ago, the Argentine government declared bankruptcy, and the bondholders got very little back on their investment. So it's not that it's not possible. We hope it's not, okay? With government bonds, I'm not going to talk so much about the savings bonds that you might have gotten that Aunt Mary gave you when you graduated from high school, or, you've all heard of those, right? The Series EE bonds or whatever. I don't consider those to be asset-generating bonds. And the reason for that is those savings bonds are actually what are called accrual securities. So it means when they do generate interest, but that interest accrues to the value of the bond itself. It doesn't get paid out to you. So the only way you can get that interest back is to cash the bond in, okay? And the types of assets that I really want to talk to you about tonight are ones that are paying interest or dividends directly to you if you choose to do that, or you can have them reinvested. With savings bonds, you can't do that. So that's why I'm kind of eliminating them from the discussion. The other types of government bonds that you can buy are called treasury bills, treasury notes, or treasury bonds. Bills tend to have a term length of less than a year. Notes have a term length of over a year, but under, I think, 10 years, and the bonds are over 10 years. There's also a U.S. bond called a Treasury inflation protected, or a TIPS bond, which adjusts to inflation, and that's a 3-year bond that you can get. When you buy those bonds, we'll talk once we go through the other categories of how you can buy these. When you buy them, they pay interest every 6 months to you, and that interest gets paid directly out to you, okay? Government bonds, US government bonds, if you buy them directly, those are the only kind that you can't have the interest reinvested. It's gonna be paid directly to you, okay? But there is, of course, a way around that. With municipal bonds, and the other key thing about US government bonds is the interest that you get from them is exempt from state and local income tax. So that makes it, yes, even more, because I saw some people's eyes light up. Anything that gets you away from tax is a good thing, right? So you're gonna like municipal bonds even better, because municipal bonds are issued by the municipality that you live in. If you live in New York or New Jersey, very high tax places like that, it's good to know that municipal bonds, the interest on them is exempt from federal, state, and local taxes. You pay 0 income tax on the income from municipal bonds, okay? What's important is the municipal bonds you buy are from the municipality that you live in. So if you live in New York, you don't want to buy California municipal bonds because that's not going to help you because you pay taxes here, right? If you live in New Jersey, you'd want to get New Jersey tax-free bonds. If you're in New York, you want to get New York ones, but they're tax-free. You have to report it on your tax as non-taxable income. And that's always, the bigger that number gets, the happier I always am, because I'm like, look at all this that I'm not paying you anything for, okay? So those are municipal bonds. Corporate bonds are issued by corporations, obviously. So then there's a couple different things that I want to talk about on that too. How do you buy these bonds? So for government bonds, you can buy them directly if you go to treasurydirect.gov. They'll let you buy it directly from there. You go on to that site, you link your bank account to the Treasury Direct website, and then you go in and you'll tell it, I want to buy whatever you want to buy, a 2-year bond. They'll deduct the money from your savings or checking account, whatever you attach it to, and then it'll show up electronically in your account with the US Treasury. What do you think the minimum is to buy a US Treasury bill, note, or bond? Again, we're not talking about savings bonds. We're talking about the other types, the bills, the notes, and the bonds. Any idea? 100. Yeah. So remember when I said that you don't have to have a whole lot of money to save? Now is the interest every 6 months you're going to get on a $100 investment going to make you independently wealthy? Unlikely. But it's a start, right? And there's no excuse because everybody here can come up with $100 over the next 6 months to invest in a treasury bond, right?
Is there an average of what the interest is, or does it completely?
It varies, and the important thing to remember right now is because the Federal Reserve is now starting to increase the rates, generally those are going up. They're starting to go up. What's important, if you buy individual bonds from the government, when they're issued, except for the tips, but the other ones, when they're issued, that interest rate at what you bought it for stays the same until the bond comes due. So you may not want to buy a 30-year bond in a period of time when we know that the interest rates are rising because you're going to get stuck with a bond that has a lower interest rate. But there's nothing wrong with getting like a 2 or 3 year bond, right? Or you could get one of the tips, the inflation protected. They adjust it every 6 months, I think. So they will increase it as inflation increases, okay? We're going to talk about another strategy you can use if you don't want to buy them individually. For municipal bonds, usually you can buy them individually through a broker. Typically, the minimum is $5,000 to buy one. And again, they pay interest every 6 months. With the individual bonds, the interest is always going to be paid back to you directly. You can't reinvest it in the same way you do with stocks if you buy individual bonds, okay? Corporate bonds, the same. You buy through a broker. Typically, the minimum to buy is $2,000. All right? So one of the more common ways of buying bonds is through mutual funds or ETFs. When I say mutual funds, I usually mean both mutual funds and ETFs, but I tend to use mutual funds because they usually are a little bit easier to get into. All right? If you buy in a mutual fund, you can have the interest that they produce reinvested in buying additional shares of that mutual fund, or when it builds up and if you happen to have a time where you need it, you can turn that off and get them paid back to you, okay? Mutual funds are all over the map how much you can get into them for. Some of them have a minimum to open the account of $100 all the way up to $3,000 or $4,000. But then once you open that account, often you can add to it with as little as $50 or $100 at a time. So having one of these, it can be a good way once you set up that automatic monthly transfer to have it go back into there. All right. For a New York municipal fund, if you get a New York triple tax-free municipal fund, if you get up to around $15,000 right now in it, it's going to be producing around $50 a month in income for you that's tax-free. Okay, which now we're starting to talk about something that can pay a bill, right? And even if you don't have that right at the beginning, again, once it starts to build, and if you reinvest and you keep adding to it, it can become a really nice source of income for you, okay? I usually don't tell people to buy US government bonds through mutual funds, only because you can buy them directly yourself without paying a fee on it. The time you may want to do it, if you're really interested in getting US government bonds, is because it would allow you to reinvest the dividends in more shares of the mutual fund. So that might be one reason you would want to do that, all right? Corporate bonds, again, it's easy to get into them through mutual funds, and because corporate bonds tend to be riskier, having it in a mutual fund or an ETF is gonna, again, mitigate your risks, right? If you start looking into corporate bond funds, there's two kinds that they'll tell you they have. They have investment grade bond funds, and they have high yield bond funds, okay? The distinction, which is very important, is the investment grade bond funds for corporate bond funds means that they're bonds that were issued by basically what are considered to be blue chip companies that are very stable, have a very good chance of paying back the bonds that they've issued, right? High yield, which sounds very enticing because you think, oh, we're going to get a lot of interest on this, contain junk bonds. Right? These are the bonds that are issued by companies that are having trouble getting revenue, so they have to offer a higher interest rate in order to get people to loan them money. Okay, so don't let the name of it fool you. Because if they said, here we're selling a junk bond fund, most people would be like, yeah, maybe not, right? But if they say we're selling a high yield fund, you go, ooh, okay, yeah, I want those big, returns. And I'm not saying don't look into that. I'm just saying understand the risk that you're accepting if you decide to do that, okay? And they will pay higher interest rates. And corporate bond funds, probably you can have a little bit less than a mutual or a municipal bond fund to get to that $50. I'm guessing like around 12 or so with a corporate bond, 12 to 13, probably 13-ish. You'll start to see around $50 a month. Bond funds typically pay interest every month on the fund, okay? Any questions on any of these bond funds that we talked about before? We're going to have questions at the end as well, but just in case there's something that's really unclear at the moment. Yep.
Was that dollar amount that you said, that monthly dollar amount that you put in, that monthly dollar amount that at this point is recouping maybe 50? Did you say that was 1,500?
No, it's 15. The question was, when I was talking about how much you could have right now, about how much you could have in a New York triple tax-free municipal bond fund, how much would you have to amass in there to get to $50 a month in interest? It's $15,000. Yeah. I wish it was $1,500, and if we find one that's $1,500 that gives you $50, we're all jumping into that like right now, because that would be great. I want to talk briefly about a laddering strategy, because this is for and I'm going to talk about it in the context of the US government bonds. Because this is one way that it might pay to buy individual bonds and sort of trick yourself into, you're not really reinvesting it, but you're sort of setting it up that you have money coming due periodically. So let's take the example of a two-year US Treasury note, okay? If you know every 2 months I'm going to be able to come up with $100 to invest in a 2-year treasury note. You set up your account, you start buying it, $100 every 2 months, you keep buying it, right? That means each of these bonds every 6 months is also going to be paying you whatever, a quarter in interest or something that's going to be thrown into your savings account, right? Until they come due in 2 years, at which point you can turn it over and reinvest it, or you can add another $100 to it. So now you start having $200 bonds, right? Which are going to pay a little bit more interest. As you start building this up, 2 things happen. One is you're going to be getting more money coming in from them because they're paying money every 6 months. But the second thing is it almost becomes a sort of additional emergency cash resource, right? Because you know that every 2 months, one of these bonds is going to be coming due. So if you really needed some money, you could take money out of it. And particularly when if you start building them up as they come due, and you get up into like $1,000 or so, that could be really handy to know, well, I know every 2 months a bond is going to be coming due, which I can either choose to reinvest it, or I can take part of it if I really need it, or I can add to it, or to know that you have that. So it almost becomes another form of an emergency cash that's in a very safe kind of investment because it is guaranteed by the U.S. Treasury, and it's also producing some income for you at the same time. So that's another way you can get into U.S. Treasuries without them necessarily reinvesting directly, okay? Let's talk about dividend stocks. So what are they? Dividend stocks are companies that pay dividends. The reason they pay dividends is because they're giving some of the profit of the company out to the holders of the shares. As a holder of the share, you are an owner of that company, and therefore you're entitled to the profits, okay? Typically, the types of companies that pay dividends are companies that have been around for a long time. You hear the term blue chip companies. You've all heard that at some point, probably. Those are the bigger companies that have been around for a longer period of time, right? They tend to pay out money to their shareholders, their profits to their shareholders. Smaller companies, newer companies, typically don't pay dividends because they're using the profits that they make to reinvest in the company, to grow the company, to make it bigger, okay, or to invest in new technology or something like that, right? So typically, the dividend-paying companies are the bigger companies that have been around for a longer period of time. So they used to be called, some of the best of them used to be called widow and orphan stocks. And what that meant was, for widows and orphans, they would buy those stocks of those companies to give to widows and orphans because it provided a source of income for them, right? A typical widow and orphan stock would be a utility company, like an electric company, right? Because they're not really building, well, we know they're not building their infrastructure, but they're not building it enough, but they have a lot of income that they have to pay out to their holders, right? Banks are another typical widow and orphan stock. Water utilities, sometimes oil companies can be widow and orphan stocks. Any of those companies that generate a large amount of cash that they need to pay out to their shareholders, right? The other kind that is interesting to look at are called dividend aristocrat stocks. And these are companies that over long periods of time have not only consistently paid dividends, but have consistently increased the amount of the dividend that they pay. So they've been classified as dividend aristocrats, okay? And you can find a list of those companies very easily by just typing in dividend aristocrat stocks, and you'll get a list of them, or you'll find mutual funds that invest exclusively in dividend aristocrat stocks or in widow and orphan stocks, okay? Again, with stocks, you can buy them individually, or you can buy them in mutual funds, okay? Mutual funds, let's talk about that first, because the buying them individually is a little bit trickier, or can be a little bit trickier to do economically or do with small amounts of money. So just like with bonds, you can find mutual funds that you can open for as little as $100 up to a few thousand. For dividend-paying stocks, you either want to find, like I said, you can look for ones that are specifically dividend aristocrat mutual funds or ETFs. Widow and orphan I don't think they actually call them widow and orphan, but they'll call them maybe the utility stocks. Equity income is the other thing you want to see in the name of a mutual fund that specializes in dividend stocks. So it's either going to be dividend income or equity income. All right, those all would invest in them. Typically, mutual funds that are dividend-paying mutual funds only pay dividends at the last month of each quarter. So they'll sort of accumulate them and pay them. So just be aware of that. Whereas the bond ones tend to pay every month, the equity income, the dividend ones tend to pay just the third month of each quarter. Okay, so you'd have to, if you're relying on that for income, you'd have to take that and spread it out over 3 months, right? Again, you can have them reinvested so that they can keep growing and making more and more, or you can take them out as you need to, right? Buying them individually, usually you have to buy them from a broker, right? So you're going to pay a commission on it. So often you have to have larger chunks of money in order to buy, because you have to tell the broker, I want to buy X number of shares of this stock, right? So you have to have the money for that. There are a couple discount brokers that allow you to do automatic monthly investing in stocks for very limited amounts of money. One is Capital One Broker, which is it used to be the Share Builder account, right? They have an automatic monthly thing. They charge you $3.99 a trade. So you could say, I want to do $50 a month or $60 a month or $70 a month, and you direct it as to what shares you want it to buy. So if you looked at the Dividend Aristocrat list and you said, oh, there's a couple on there that I really would like to start owning, you can set this automatic monthly thing up, have them direct whatever you decide, 60, 50. I don't usually tell people to do less than 50 because at $3.99 a trade, you're losing. If you go less than 50, you're losing quite a bit of that. And they'll buy fractional pieces of the share if they have to. And they'll keep building it up. You can turn it on or off whenever you want to, and it'll just sit there and accumulate, right? Usually with the stocks in the share builder, though, you can't have the dividends redirected, so they're going to keep reinvesting. So if you got to the point where you accumulated a position, in a larger position of stocks in something like your Capital One, you might then want to move it over into a more traditional broker where you can tell it not to reinvest the dividends. Okay, so that's one way you can get into individual stocks if you want to do that. Now, one of the questions is always, the financial people out there are always like, why would you tell anybody to buy individual stocks and not buy mutual funds? Because mutual funds, obviously we said, are diversified. They limit your risk. You're buying a lot of different things, right? If you're buying individual stocks. The main reason I say is because it's fun, right? It's much more interesting to say, I own 10 shares of Coca-Cola than it is to say, I own 10 shares of an equity income fund, right? So a lot of times, and I'm not saying just do only individual stocks, but I'm saying I know a lot of people who like to sort of buy a few shares of some individual stocks because it's fun, and that encourages them to buy the mutual funds that are the sort of stable bread and butter of what you need, but are kind of boring, right? So do it because it's fun. I mean, Anyway, any questions on stocks? Yep.
I had a survival job with one of those companies, I guess a Dividend Aristocrat, and I have a major amount of money from company sharing, and I'm being told either to save, to keep it there because of the dividends I'm getting up there and might use them in a year or two, or just sell it because I'm too top-heavy in there. And I'm just not, how do you weigh those two things?
So the question is, she worked for a company that was one of the kind of dividend aristocrat companies that gave you, as part of your compensation, you got shares in the company itself, which probably means that you're fairly concentrated in terms of your overall portfolio. There's a concentration of money in that stock that is, in fact, paying dividends. So how do you decide what action you should take with that, right? One of the questions I would tell you to ask yourself is, are you taking the dividends directly, and are those dividends helping you? If you decided to reduce that position by a certain amount, not necessarily by all of it, but by maybe some of it, how much could you reduce it by, but still be getting a steady stream of dividends that was helpful to you, and then you could take that money and put it into other places. The other thing to think about is, are you going to be building up other elements of assets in your portfolio, which is going to make it not so top heavy then? Because if right now that's about 1/10 of your overall portfolio, if you start investing in other areas of your portfolio, that's going to decrease what that is so that you can maintain that position and still get the dividends. So that's kind of some general things to think about when you're looking at it, but that's a great problem to have, right? To say, oh, gee, I don't know if I should keep these dividends or, should I, But it's nice to have the dividends coming in, I'm sure, right?
Well, yeah.
Yeah. Exactly. They reinvest it. You might also want to ask them if it's possible to not have the dividends reinvested and have them sent directly to you. So that then you're not increasing the position that you have in that, but you're maintaining what you have, but you're then utilizing that money either to spend or to invest in something else. So that's another option that you can have. The other thing I want to talk about with stocks are there's apps out now that can help you get into the stock market for very, very little money. One of the apps that's fairly new is called Acorn. Have any of you heard of Acorn? Do you actually use Acorn? Yes, you do. So basically, for those of you that don't know what it is, it's an app. You link it to one of your credit cards. It rounds up every purchase you make to the nearest next dollar and then invests that change in a portfolio of stocks, or a mixture of stocks and bonds. So what you do is when you set up your account, it will ask you some questions about how much risk you want to take. And I think there's like 5 or 6 different sort of portfolios that you could choose from depending on your level of risk. The money from your credit card, the rounding up of it is used to purchase shares in that portfolio, okay? Up until you have, when you have less than $5,000 in that account, they charge you $1 a month. After that, I forget, it's like 0.25% or something over the year, or there's some charge over the entire thing. But that can be a really great way to sort of ease yourself into the market without noticing it, okay, using your credit card. One thing that I would tell you to be cautious of is if you're one of those people that never uses cash and only uses credit cards, if you have, tend to have a lot of charges on your credit card each month, remember that they're going to round up each of those. So the most they could round it up is 99 cents, right? So think the worst of all possible worlds. If you have 100 charges on your card each month, that could be adding another $100 to your bill, or probably more like $60. So just keep that in mind, because what you don't want to do is if you're not paying off your credit card bill every month and you're adding more to it to invest, I guarantee you the interest that you're being charged for the balance that you're carrying is not going to be offset by the money that you're investing in your Acorn account, okay? But if you're someone who pays off your credit card all the time and you don't tend to have a ton of charges, it can be a really great way of sort of sticking your toes in the water and getting invested in the market, okay? There's another one called Betterment, which again you can invest in. It will help you pick and Betterment is run by a robo-advisor. So it's a computer program that chooses the investments that your money is being made in. They charge a very, very low fee, and you can get into that for very little money. It's not tied to a credit card. You actually put money into it, and then you can set up automatic monthly investments in it. And another is called Wealthfront. That's another of these kind of apps that you can get into for a very low. I think Wealthfront, the minimum to open an account is like $500, and it's again a robo-advisor. So there's a lot of really easy ways to ease into the market without feeling like you're taking a lot of risk if you're adverse to it. Yeah.
You're saying that really that's because it's fun to do that? I mean, is that still the rationale behind doing like Acorn, or because it's more fun than buying a mutual fund? Or is there
So the question is the reason that you would want to do one of these apps because it's more fun than, no. I look at individual stocks as being fun. I look at these as being sort of new technology. I think the benefit of Acorn is if you're, it's little bits of change. And if you're not doing anything else and you think, I can't even figure out how to do like $5 a month yet to do into something, or I'm, you keep procrastinating, and that's a really easy way to start building up something so that you can sort of get an idea of what to expect when you're investing in a mutual fund type of investment. Yeah, it doesn't certainly have the fun of, like my family opens one of these Capital One investment funds for my nephews. Whenever they turn 16, we open a stock account for them and we put a little bit of money in every month. And then when they turn 21, it gets turned over to them. So the most recent nephew that turned 16, the first stock we bought for him was McDonald's, okay? So, because he goes to McDonald's all the time. So, we said, the next time you go into McDonald's, you can say, I'm an owner of you, as you buy your Big Mac. And that was really cool for him. So it's fun, But the Betterment, Wealthfront, and Acorn aren't going to have that same level of fun. But yeah, they're still, it still is going to give you an idea for very little money of what it's like to be in a mutual fund. Let's talk about, yes.
Quickly,
Sure.
You mentioned there was another company that provides services like Capital One Broker.
I don't know the names of them. There's a couple other discount brokers that have tried to mirror that. I believe one of them might be called Interactive Brokers. I know there is an Interactive Broker, which is a discount broker. But if you just Googled automated monthly investment stockbroker or something, they'll pop up for you. But Capital One is the one that's been around the longest, which is now, it used to be ShareBuilder, it's now Capital One. That's been around the longest, and that's the one that the others are trying to mirror. Yep.
Just a quick question about apps. I've seen advertising for something called Stash, and I wanted to know if it's something you heard about.
The question is, within apps, there's one called Stash, which I'm not familiar with. No. But I will look into it now. Yeah, definitely. I want to give you a compounding example, just to give you a better sense of how that works. Here's the premise that we're starting with, and I'm going to tell you right off the bat, this is incredibly unrealistic, okay? But I don't like to do math in my head, so I tried to pick an example that was going to be easy mathematically, but even though it's like ridiculously improbable. So the premise is that we bought 100 shares of this miracle stock that trades for $10 a share. And the first thing about this miracle stock that's a miracle is that it never varies from $10 a share. It's always going to be $10 a share, so I don't have to do extra math. And it also pays a $4 dividend, okay, which again is completely unrealistic. But if you find one that's $10 and pays $4, let us all know, because we'll jump into it. So by $4, the $4 dividend, because it's $4 a year, that means that it pays $1 every quarter, because dividends are paid quarterly, okay? So we get to the first dividend payment, which is $100, right? Because we have 100 shares. So it's $4 a year, it's $1 a quarter. We get $100. That means because we're having it reinvested, we get 10 more shares, right? So now we have 110 total shares of it, okay? So the next time the second payment comes around, we still get $1 a share, right? So now we have a $110 payment for that dividend, which buys us another 11 shares. Okay, so now we're suddenly up to 121 shares, right? And again, this is completely unrealistic, but we're doing it just for my ease of math, yeah? So now we have 121 shares, so we get now $121 for the next dividend payment. Okay, that gives us another 12.1 shares, which now brings us up to 133.1, which means the next payment would be $133.10, and I stopped doing the math at that point because we get into decimals, and you don't want it. That's not pretty. So that gives you an idea. And again, even though this is unrealistic, if you think that that's how it grows, okay? The other thing I like to tell people about, because some people are like, yeah, but if we buy dividend stocks or we buy shares of an equity income fund, right? And then there's a stock market crash. There's going to be a stock market crash. It's inevitable. That's the way the market is. The market goes up and it goes down. It's been up for a very long period of time. It's going to go down, right? That's inevitable. Over time, though, the stock market has always outperformed inflation and always done very well, okay? The other thing that I tell people is when you're investing in things like dividend stocks or like bonds for income, it's different than when you're investing in stocks to make a capital gain, where you're looking for a big movement, right? If you have stock that is currently trading at $20 a share and paying $1 dividend a share, or shares of a mutual fund that are at $20 a share and are paying $1 dividend, if the stock market crashes and it goes down to $15 a share, it's still paying $1 a share, right? You're still getting the dividend, unless something happens to the company fundamentally, which happened to some of the banks during the banking crisis where they had to cut back on their dividends. But typically most of these aristocrat stocks and these blue chip, that isn't the case. It's just that the market has corrected, but the amount of dividend you're getting is based on the number of shares you have. And if you're reinvesting in those periods of time when it's very low, you're actually accumulating more shares, which are going to pay more dividends. So that's something to keep in mind, okay? You're not, for these purposes, you're not investing for the capital gain of how much it's making. You're investing of how much income it's giving to you. And that income doesn't change based on the share price, okay? And I think that's really important for us to understand, all right? I've gotten into 2 semi-fights with financial professionals over me buying municipal bonds. One was a broker and one was a mutual fund person, because they said, you shouldn't be buying municipal bonds. You're too young. Why are you doing that? That's what old people do. And I was like, well, but let's think about what I want. And the reason they say that's what old people do is because they say, there's less volatility in municipal bonds, so that it provides a source of income. And I said, yeah, but I'm in a profession where I have an uneven income flow. So to me, creating a revenue stream that is tax-free on the federal, state, and local level and is paying a regular payment to me has a lot of appeal, because that can be income that I need in times when I'm not earning that much. And finally, one of them I was able to get around to going, oh, yeah, I guess that does make sense. The other one is still hopelessly mired in no, this is what my script says. It has to, I was like, yeah, but I don't kind of fit in your script, so, So that's one of the ways, those are a couple of the things to think about when you're looking at this, that the financial information that's out there is a little bit different than that, right? Because they're looking at people who have regular jobs and are expecting to get, to retire at a certain time and get a 401k, all right? Real estate. So how do you think you can buy a co-op or a condo or a house for $100 and make rent off of it? Probably not gonna happen, right? Have any of you ever heard of REITs? Real estate investment trusts, okay? They're like a mutual fund, or they can be like an ETF, a share of stock, that invests in real estate. Typically what they're investing in is commercial real estate. So some of them invest in malls, some of them invest in corporate buildings that they're leasing out to other people. But basically it's you're buying shares of this fund that owns pieces of real estate, okay? So you have exposure to the real estate market and you're a landlord without having to be a landlord and put out a lot of money. The important thing about REITs is that they must hold the bulk of their assets. This is by law. They must hold the bulk of their assets in real estates, okay? And typically it's not like, Joe and Mary's house that they have. Like I said, it's usually commercial real estate, building developments. The other key thing about REITs is that they are required to pay out every year 90% of their taxable profits to the holders of their shares. Yeah, wow, yeah. Now, during the housing bubble, a lot of these REITs went out of business because the housing market was overinflated, right? So understand the risks that are going into it. Now, there have been a lot of laws that have been put into place to kind of prevent that kind of mortgage and real estate bubble from happening again. But know what you're getting into. Know that that's what it is. And if you start to see signs of that, if you happen to go into these kinds of investments, know that that's what it is. As I said, you can find REITs as mutual funds. Usually they pay out, it depends on the particular mutual fund. They either pay out at the end of each quarter or some of them will pay on a monthly basis. You can also find certain stocks that represent REIT corporations. So you just have to look at, again, you can either Google REIT stocks or REIT mutual funds or REIT ETFs, exchange traded funds. The one other type of mutual fund or ETF that I want to tell you about are sort of hybrids that are specifically geared towards income generating, but also stability. So usually what they do is they have a combination of bonds and stocks within them. And a lot of times they'll be called like something like new income or income funds. Those usually also pay dividends or interest every month because that's the point of what they're there for. But having a bond component to them gives them a little bit more stability in terms of pricing, but it still has the stock to sort of benefit from the increases of capital gains. Okay, so that's one other kind of mutual fund or ETF that you can look into, new income. Finally, take control of your finances. And how do you do that? Commit yourself to having financial wellness. Hopefully you've seen that there's many ways that you can do that without having to have a lot of money. You can start very small. There's little ways you can start building your portfolio. Think of it as a mosaic where you're putting little pieces of tile in depending on what your circumstances are to start building your financial picture. The other benefit that you have to doing it when you are using small amounts of money is that once you lay that foundation, at those times when you get the commercial or you do the film and you have a big chunk of money coming in, you say, wow, I've already got this framework in place. I know where to put this sudden flush of money so that it can start helping me even more instead of just suddenly going, now what do I do with it, right? So if you start putting these little pieces into place, those periods of time where you're making a lot of money, you're gonna know what to do with it. You're gonna have a better sense of what to do with it. And then you can say, oh, I can fill in a couple more of these gaps. Yeah? You owe it to yourself to take control of your finances. It's gonna help you do more in your art. And that's what's important for you, right? Do it for yourself. Educate yourself. So you can all tick that off the box now because you're here, right? So you've started to educate yourself and you started to learn. Keep that education going. It's never gonna end. You never, as an artist, you never reach the end of your learning, do you? It's always something more to learn. Think of your finances as the same way, okay? You wouldn't not take an acting job because you didn't feel that you knew everything about acting that you had to know, right? Or else we would never work, right? Part of the learning of it is the doing of it. The same is true of your finances, okay? You have to start doing it to learn. That doesn't mean you run in blindly and say, hey, I'm gonna take these couple $1,000s and throw it into something that I have absolutely no idea what it is. No, find little ways that you can move into it that you're comfortable with. You're gonna learn so much more as you start to do it. Yeah, I've had so many people come back and say, you know, I started buying these little like mutual funds and then it suddenly started making more sense to me, the whole reinvesting of the dividends and the capital gains. And I started to see what the tax consequences were, which weren't that bad because usually those rates are much lower than on your income. And then you start to see how they're building and then you learn what you can do for the next thing. So think of it as an ongoing process of education. And don't beat yourself up if you don't know something, you know? That's part of the learning. That's part of the what you need to do for yourself. Also, analyze your current situation. The regular people out there, the advice to them tends to follow the same path. If I talk to every single one of you individually, we would come up with different things that you could be doing or should be doing right now for your finances. And a year from now, it's gonna be even different still because that's the way your life is. It's very different, right? So you need to be able to look at your own life and say, what's the most important thing for me to do financially right now? And where do I need to put my finances, right? That's important for you. The other thing that I really don't like about the regular people advice out there, it really sounds horrible when I say that, doesn't it? We can edit that out, right? And I hear, and Susie Orman, if any of you listen to Susie Orman, the thing that bugs me about her, she gives great information, but when she says, they say, I'd like to do this. No, 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 no. You can't do that. You have to save this. You can't, when you're 60, you'll be able to do that, Look, as artists, we have to live our lives, right? We can't, if we put off everything that we want to experience in our life, we can't do our art because that's what feeds how we are as an artist, right? That doesn't mean you should ignore your finances. So we have to find the balance of what we do for ourselves to help make us better artists, but also take responsibility for helping to give ourselves the financial stability that we need, which is going to enable us to be even freer as an artist, okay? And only you know that for yourself, right? Because you're going to be unique to you. Then I always suggest people plan a monthly hit list. This can be, we've talked about a bazillion things tonight, right? So some of you are going, I don't even know where to start, right? I don't know what to do. So I say, at the beginning of every month, give yourself 2 or 3 things that you say, I'm going to explore that this month. Maybe it's just, I'm going to look up what aristocrat stocks are this month. I'm going to investigate a mutual fund that specifically is New York tax-free mutual or municipal bonds, right? Pick 2 or 3 things at the beginning of the month to give yourself to try to accomplish for that month, okay? If you get to the end of the month and you haven't done them because you've been too busy, you've been doing a film shoot or whatever, it's not the end of the world, but try to get through your hit list. It helps give you something that's manageable to look at. The other thing I tell people is I had a woman in my class one time say, when I'm preparing to do a role, I don't have time. I'm doing everything's going into that. I can't think about any of this and everything. And I said, I mean, I've been there. I did that too. But when I was doing a concert, I still managed to eat. I still managed to somehow get my laundry done. I maybe didn't do it myself. I maybe took it somewhere. I still managed to keep some semblance of cleanliness in my apartment. It might not have been pristine, but I managed to do something, right? You can manage to do your finances too, even when you're really busy. And then when the times when you're not that busy doing your craft, you can focus and sort of put some more things in place that are going to take care of themselves later on, like monthly investing and things like that, all right? So make it part of the fabric of what you do. And so even if you only put a couple things on the hit list, try to get them done even if you're having a really busy month. And they can be easy things to do. Just then you'll at least feel like you're accomplishing something as well, right? Finally, here's some contact information for you. I think Melissa mentioned the book that I wrote, The Thriving Artist. That's the cover of it. If you have any interest in checking that out, it's on Amazon and other bookstores. My email address, if you have questions, if you email me and say, should I buy 100 shares of Coca-Cola tomorrow, I'm going to politely decline to give you an answer, but I will tell you where you can do some research to see if that might be a good thing for you to do. I have a website where I announce other things, a Twitter account, and Facebook. On that Facebook page, The Thriving Artist, I post weekly tips. So if you're interested in seeing those, you can like the page, and I post weekly sort of mini financial tips. And by all means, if any questions ever arise, don't hesitate to email me because I'm always happy to try to point people in the right direction. All right, so I think they're going to get microphones in case some people have other questions or not. You might just say, okay, we're ready to go. Let's go buy some mutual funds and be done with it, right? Thank you, though, for your attention. I really appreciate it.
First of all, thank you so much. Do you do private consulting? If we were to meet with you and you could sort of look over our portfolio and just...
In a manner of speaking,
ask questions?
I'm a financial educator, so I'm not a financial planner. So I do at times sit down with people and talk to them about where they're at right now and some areas that they might want to look into moving. You can email me and I can sort of give you a better thing. But I always make it clear, my interest is in helping you understand how to help yourself. And even if that means that you're going to eventually have a financial advisor that's actually investing your money for you, which is not something I would ever do. But even if you get to that point that you understand enough about what they're doing, that you're comfortable with what they're doing for you. Because there's nothing worse than hearing about these people that have all this money that they turn over to a financial advisor, they don't really pay attention because they don't understand it, and then it's gone. So
If I had an advisor and I have investments, would you be able just to, for a
yeah, send me an email and
Okay.
we can chat.
Yes, hello. Thank you. I have two super fast questions, and one was the lady with the job investment thing that's already set up. There was one word talked and referred to, and I don't know what that means. Head heavy. What does that mean?
Top heavy.
Top heavy. What is that?
Remember when we were talking about that you want to have a diversified portfolio so that you mitigate risk by having many different types of investments, so that if something happens to one of them, the risk is spread out over other things
So
that it's
if-
not. So what she was saying was that because she had this one stock of one company, there was a large percentage of her total invested assets was in that particular stock, and she thought it was about 10%. That tends to, so if 10% of your portfolio is in one stock, if something would happen to that, that's a lot of risk that you're taking on with that.
Okay.
So you want to try, so we were talking about ways that she could sort of reduce the risk
Yeah.
of that.
The other quick question is, you said there are, if somebody makes like a big movie and makes a chunk of money all of a sudden, should they, like, if they think, oh, should I buy an actual apartment or a house somewhere that I could possibly afford, or should I invest in a like apartment, like REIT, like an apartment stock? I mean, a real estate stock or an actual real estate? What do you think is better?
Well, it's impossible to answer that without knowing specific circumstances of every person. Because again, what I was saying, every person's going to have a different answer to that. So if you're someone who has set up a lot of different assets, for example, you have a lot of different little assets, and you have the ability to buy a home for yourself, and you already have some assets, and that's the goal of what you're going to do with that. That can be a really good thing to do. If you have a really good living situation that maybe you don't, it's not so urgent that you invest in a house because you're in a rent stabilized apartment that you really like, or something else, or you know you're going to be getting a home later on, or you're not ready to own a home right now, but you want to invest it in assets that are going to support you doing that at some point in future, then that might be the better way to go. So it all is very specific to the circumstances that you're in, and also to the way that you want to live your life.
Yeah, I only meant it in terms of making actual plus money, not to live there. I only meant it in terms of
Oh,
actually
you mean
making
like to
money.
buy an apartment to rent out to someone
Yeah.
else? Well, then the question becomes, are you willing to be a landlord or have someone manage that for you? And how much is it gonna, if you're not being a landlord yourself, how much is it gonna cost you to hire a management company to do that for you? If yes, I have friends who are absolutely into being landlords. I would hate being a landlord. So,
Does
you
that
know, for
usually
me,
go?
the question is, no, if I'm going to have a real estate investment, it's definitely going to be in something where I'm not the landlord, that somebody else is
Yeah.
dealing with it, and it's in the REIT arena. For my friends that love doing that, or have their, are happy with a management company, they go into it that
Yeah.
way. So again, it comes down to a question of what you're comfortable with,
Right,
and
right.
what kind of role you want to have in your investment.
Yeah.
The REIT
So-
is more of a passive investment. A direct ownership of an apartment would be direct. You would have to have an active in.
But it's kind of like more or less the same when the real estate market, like Manhattan, it goes up like so fast, and it would be like practically the same, like a growing, if you buy a stock, or as if you have like the real actual.
Well, it
apartments,
depends on
same
it, but
thing?
again, it depends on the REIT that you're buying, because different REITs could have different types of real estate in them. So you might have a REIT that has commercial real estate that's primarily in the Midwest, Or you could have a REIT that has commercial real estate that's in the South, or some that's representing all over. So you have to look at, again, it's not an easy answer. The other thing is with owning a single piece of real estate, again, it's dependent upon that one particular real estate. Within a mutual fund, you have many pieces to it. So you just have to think of all those factors and then figure out what your comfort level is in terms of risk and in terms of how much involvement you want to have in it.
Thank you so much.
Sure.
I have two quick questions. Are all fees involved in investing, such as expense ratios, fees, percentages, and so forth, and perhaps advisor fees, are they tax deductible?
Let's see. Some of your advisory fees could be. The expense ratios generally just come out of the profits of this, so that's not a specific tax deduction. Interest that you pay to your broker if you have loans from your broker, that can be tax deductible. So you have to check. You'd be better to check with your tax advisor on exactly what pieces of that. I know within the mutual funds and the ETFs that the expense ratios are embedded in the value of the company, so you're not going to be able to deduct those.
Thanks. And lastly, did you mention that municipal bonds are available through brokers or as a part of a fund?
If you buy individual municipal bonds, you must buy them through a broker. So if you wanted to buy, if you were in New York City, if you wanted to buy what they call a GO bond, which is a general obligation bond, which is basically the New York City government is loaning you money and they're going to use it for whatever expenses they see fit. If you want to buy an individual bond like that, you would buy it through a broker, okay? If you want to buy a municipal bond that has a bunch of those, you can either buy it directly from the mutual fund company itself, where you're not going to pay a commission for it unless there's a load on it, but you're going to get a no-load one. Brokers often also will sell mutual funds, but they often charge you to buy the shares of the mutual fund, which you could probably buy yourself directly from the mutual fund family.
So I would Google that or
Google.
find out municipal bond companies? Or?
Yes, if you wanted to, you could do it two ways. You could either go do a Google search of New York tax-free municipal bond funds, or if you know some fund families, some of the top mutual fund families are Vanguard, T. Rowe Price, USAA. You've heard of some of those, right? Go onto their website and look for, depending on where you live, New York tax-free bond funds or New Jersey tax-free bond funds. Be sure that you're looking at tax-free bond funds and not tax-free money market funds, because they're very different. A money market fund is like a savings account. A bond fund is specifically investing in municipal bonds. Okay, so you want to look for New York tax-free bond fund or New York municipal bond fund, one of those.
Thank you.
Sure.
So, hi, my question, thank you so much, by the way. So in educating as part of maybe like the 2 steps you could do per month, one would be, let's say you want to get more sort of acclimated to a mutual fund. What would be a minimum maybe you could put into a mutual fund just to sort of understand how it works and if it, it's a good fit for you? Is there a minimum to put into a mutual fund?
Each fund and each fund family have different minimums.
Okay.
You can find some, I think Charles Schwab offers some that you can open for $100.
Oh, okay.
Vanguard, typically the minimum to open is $3,000 for their mutual funds, just the minimum to open it. Then it's less to add on. T. Rowe Price is about $2,500 typically. USAA is between $2,500 and $3,000. So
those
for
are good
fairly
to
small
start,
amounts of money,
yeah.
you can.
And same
The
with
first mutual fund I bought, which
Yeah.
was back in the dark ages when you actually had to write checks to pay for it, was like $1,000 to open it. And I was like shaking as I was like writing the check to send it out, because I was like, it's a lot of $1,000 is gonna go. And you start getting the statements every quarter and you become very acclimated to it. And you go, yeah, this isn't, okay, I get how this is working. So it's a good way to sort of get into the game and sort of get a sense of it.
So that's what I think my next question was. So that would be that along with maybe putting like a little bit into a municipal bond is a good way to start to educate and like, okay, great.
And then you can set, like if you open one up and you sort of get a sense of how it's working and what's happening, then you could, like, for example, set up one of those automatic monthly transfers. So you transfer like $50 every month that happens automatically, and then you can sort of see how that causes it to grow when that's added to the dividends that are being reinvested or the interest that's being reinvested. So, and that's a great way to build up different funds. Early on, what I would do is I had one fund, and then I would do automatic payments to it until I got it up to a certain point, and then I'd be ready to buy another fund that would fill another part of my portfolio that I wanted filled in and do the automatic monthly payment to that one. So I kept building up assets over time in these different kinds of funds.
Thank you.
Sure. Yep.
Thank you. Hi, thank you for all this wonderful information. I had 2 questions. Is the book available ebook, like a Kindle?
It is.
Okay,
Yep.
cool.
Yep.
And you mentioned about having a base, like know what your base is that you need a month.
Mm-hmm.
I do have systems set up in Capital One, and I actually paid $12 to do unlimited stocks, buy stocks.
Mm-hmm.
No, not unlimited. I get to do 10 a month, but I only have 3 in an automatic. So I have these systems set up, and let's just say if a $4,000 base a month, what's a goal that should be invested that I could pull out $4,000 a month?
You mean your monthly nut is 4,000?
Yeah, let's say if it's 4,000, what should be out there that I can, yeah,
Wait, you're trying to build up enough assets to be generating $4,000 a month?
yeah.
Again, it's going to depend on the kind of assets that you have. I mean, you're going to need to be a fairly significant amount of money. To give you an example, my mother has an account in her. My father had set up an IRA with a dividend-paying, an equity income fund that has it has like around $230,000 in it. And it generates $1,100 a month in dividends, which is a nice chunk of change to have in dividends. But you're talking about you're probably going to need to get to $4,000 under the current environment, assuming, with dividends, you're going to be probably pretty high, like close to $1 million probably. But don't let that discourage you from building things up, because people, if the fear I have that is if you look at like, okay, I have to have this big number, you don't even start doing anything, or you give up and you say this isn't going to happen. Having an investment that's paying you even $50 a month, which is being reinvested, that $50 a month is a bill that you could pay, or groceries for a week or something. So and you're still going to be working for the moment, right? And we, as artists, are probably going to be working into what the regular people would consider to be their retirement years, because we're not necessarily going to want to stop doing what we do, right? So keep that in mind too. So it's good to sometimes look at what that would be, but don't let it prevent you from doing the things that you can do now to try to find ways of building towards eventually getting to there. Because because compounding is a geometric progression, it's really surprising when you start reaching that point where it's starting to pump in more and more, that how quickly it starts to grow later, the more time you have. Yeah?
Do you suggest, I hope it's loud enough, anyway, do you suggest putting a maximum into your IRA before you buy any of these other things? Because the bond funds are almost sounding to me almost like another way of saving, like an IRA, because it's not taxable, right? But do you suggest to maximize that and then do a REIT fund, or what's the strategy?
So the question is, do you put your money into, is the strategy to put the most money into an IRA, which is a retirement vehicle, or to start investing in some of these other assets that we talked about outside of it? And I'm again going to be contrarian to what conventional financial advice that's out there for regular people, right? Because the idea, they will tell you put as much into your retirement accounts as you possibly can because it's protected from taxation, right? They're making the assumption that you're working, making a regular salary up until the point where you're going to retire, and then these funds are going to be available to you. Again, that's not the circumstance that any of us are in, right? So my strategy has always been to build both simultaneously because you can use the tax benefits that you get from your retirement. If you have like a SEP IRA or something like that, that can be really beneficial if you have 1099 income, things like that. But the assets that you're building outside of your retirement are throwing off income that you can use for periods of time when you need it if you're not at retirement age without the danger of incurring a penalty from taking it out of your retirement. I also tell people the money that you have invested outside of retirement accounts doesn't disappear when you become of retirement age, right? It's still there as an asset. It's just that, yes, for some of them you can be paying taxes. For the municipal bonds, that's one of the things I like the most about it, is you're not paying taxes on it anyway. So why not have it? And you don't want to have that in your retirement account because you're already getting the tax break in the retirement account. You don't need to put a tax-free thing in there, right? So that, to me, is kind of a no-brainer that you want to sort of build that asset. But even some of the dividend stocks and things like that, I mean, those are assets that you can still use before you reach the age of retirement at 59 and a half. So I always think of it as kind of like you're always pushing a lot of different balls up the hill at the same time, which we all do in our art all the time anyway, right? We're used to like wearing 75 million hats and doing everything. It's like you build it all at the same time. And that's a little bit different too, because like I said, they generally tell people that are working, because they're assuming that they're making this income regularly that is going to put them in a tax bracket that doesn't make it worth it for them to have assets outside of that. And that's not generally the situation that we're in. So yeah, I hope that helps. It's tough because you have to look at everybody's individual situation and say, what's the best thing for me? But I do get a little worried that sometimes artists hear this, that we should always just be putting everything in retirement. And I just keep thinking, well, you're not going to lose this other money outside of retirement. You know, when you get to retirement age, it's still there. It's still an asset. So why not have something available to you that's going to give you money too, that's outside of that in the meantime? Yeah.
You mentioned the Capital One Share Builder account, and it costs $3.99 a month.
Costs $3.99 a trade. For when they do this automatic. So the question was on the Share Builder Capital One account. It's for the automatic monthly investment, which is where you tell them to take a certain amount each month to invest in whatever stocks you direct it to. They charge $3.99 a trade. So you want to direct your money to one particular stock. So you wouldn't want to do, say, well, I'm going to do $60, but I'm going to do $20 in 3 different stocks because they're going to charge you $3.99 for each of those. So you'd want to do the full 60 in directed at one stock each month so that it's the $3.99 is taken off of that. Yeah. Does that make sense?
Well, that was the first half of that. The second part of that is how much money do you have to put in before that $3.99 is returned? Like you opened up the account for your nephew with McDonald's.
Right.
How much would you put into it or how much has to be put into that before the $3.99 is recovered?
So the question is when do you recover the $3.99 trade cost? So that's where it depends on the price of the stock and how the stock is doing. So if you buy it and the stock immediately jumps up, you could have that be go away immediately. I tend to concentrate on dividend-paying stocks when I buy them that way because the dividends are reinvested with no sales charge. So as the dividends get reinvested, that is another way that you sort of help to absorb the cost of the trade that you've made. Sure.
Hi. Thank you again for being here. This has been really helpful.
Sure.
Going back all the way to the beginning when we were talking about emergency reserve, We talked about the 4 kind of cash places. Do you recommend like a CD or a money market? Like, where should we park that money?
The cash. Great question. I usually say, because we all know the cash that you have in your emergency funds is getting like ridiculously low interest right now. So it's very frustrating to see it sitting there and you're not getting anything, right? One thing you want to do is you want to avoid getting penalized for having to use it, okay? For the first like couple months, I usually tell people to keep it in their savings account where it's readily available, because there's a good chance that you're going to be having to draw from that. A lot of times, the bank that you use will have, or the credit union you use, will have a money market account attached to it. There can be some limitations, like you can't take out more than 4 withdrawals a month, or you can only take out a minimum of $100 or something like that. If you put some of the later months, like the 3rd and 4th monthly nut in that, you'll have enough heads up because you already have a couple months in your savings account that you'll know, ooh, I'm getting low on there, maybe I better transfer some from, so you'll have a heads up so you can deal with those limitations. For CDs, once you get to the point where you have like 6 months to 7 months in those places, then you might get a 6-month CD because you know that you have enough money to cover the months before that CD would come due, so that there's no risk of taking it out before it comes due and paying a penalty on it, okay? The other thing to look into, if some of you just have bank accounts, if you've never looked into credit unions, you definitely wanna look into the SAG union has a wonderful credit union. Actors Equity also has a wonderful credit union. Credit unions pay generally higher interest on their savings accounts and their money market accounts, and have lower charges on things like credit cards and loans. They're great places to park some of your cash stash too. I call it your cash stash, to tweak a little bit more interest out of it. And they also have CDs. Also, they sell CDs. So.
Thank you. It's almost like you're diversifying
your cash.
Your cash
exactly.
as well. It's really
exactly.
smart.
Exactly.
Yeah. Thank you.
Yeah. Sure. Mm-hmm.
Hi. So, what is the relationship with your debt, like student loans and investing? So, like, when we do get a big job, do we put that money towards, like student loans, or do we put most of that towards investing? Like, how does that relationship?
I'm a little contrarian there too. So big surprise. I always think that you should be investing at the same time you're paying down debt. The first kind of debt that you want to absolutely get rid of is your credit card debt, because you don't get any benefit from that. You're just paying incredibly high interest rates on it, and you don't get any kind of tax break or anything on that. Student loans, you are getting a bit of a tax break on the interest that you pay on your student loans. The same with if you have mortgage interest, that you're getting that. The problem is if you focus all your assets on just paying off those debts, is that you don't benefit from compounding for as long a period of time from your investments, right? So what I did when I had a mortgage was I started paying a little bit additional on the mortgage each month when I was making more money, but was building my assets outside of that. And as you pay a little bit more on it, you eventually get to the point where when you're paying a little bit more on the debt that you have, it's like the reverse of compounding. So as you pay a little bit more, you have less that you get charged interest on, and it starts decreasing much more rapidly in the same way that compounding works on investments growing and growing. So again, it's kind of like pushing the balls up the hill. You want to do kind of both at the same time. Now, if you get a big chunk of money, it might be nice to divide part of it to, especially if you have a lot of student debt, maybe you do 50-50, or you say, I'm going to put a chunk of it into my student debt to get that paid to a place where I'm not as panicked about it, but I'm still going to put a chunk of money into assets which are going to start growing and sort of helping me out. Okay? Does that kind of answer? It's tricky, I know, but the other thing with debt, long-term debt especially, is that because of inflation and because of our earning power, the payment on that debt is going to seem less and less as time goes on to you, even though now it seems overwhelming. Like when I had my mortgage, my monthly payment was $419.32, which panicked me that I was never going to be able to pay it, right? But over time, now we look at a payment like that and you go, oh my gosh, that's nothing, right? But at that time, it was a lot. So over time, it becomes less because of inflation and because of earning power. So kind of do them both at once is what I suggest. Anybody else?
Quick question.
Thank you.
Quick two questions. Is there a minimum amount that for the real estate, the REIT you spoke about? Is there a minimum amount to have in order to invest?
If it's a mutual fund,
Yes.
it's going to follow the same rules that I was talking about for the other mutual funds. So like a company like Vanguard, their REIT would be probably a $3,000 minimum to get in because that's their typical minimum. Charles Schwab, if they have a REIT, it might be a $100 minimum. So it would depend on the mutual fund itself.
Gotcha. And second question is, are there any type of educational tools that you kind of follow yourself on a daily basis as far as educating yourself as far as continuing education?
Yeah,
as far
I read Money Magazine. I like Money Magazine because I find it's very easy to understand. Again, you have to adapt what they're talking about to our circumstances in the arts. There's a couple online places like the Motley Fool is a really great source of information. Sorry? Motley Fool, the Motley Fool.
They have a good podcast too.
That's a great, very understandable financial education site. Yahoo Finance has some columns. I look at the Wall Street Journal also, although I completely ignore the editorials in the back. But I read the news articles and the financial stuff. Investopedia, if you're looking for research on really easy to understand terminology for investing things, Investopedia is, like Wikipedia, is a good source of that also.
Thank you.
Sure. Yeah.
Hey, so I was just wondering, what about the 5% savings accounts, like Ing or like PayPal or something like that? And also, if it costs like between $8 and $18 to buy and sell a stock, how does day traders making money?
So there was two questions. One is 5% savings accounts, which I'm not, it's probably some kind of special that they're running, or is it? Yeah, sometimes banks will do that as a special, especially online banks. They'll do it to attract new customers. I always say that if something looks too good to be true, it probably is. So make sure that you know what you're getting into. Because if a bank is offering a really high interest rate, they may be running into trouble. So you want to look at what the institution is. The second question was when you're paying trading fees for stock. I think you can find a lot of traders that are as low as like $4.99, $6.99, $7.99 a trade. You're buying it in chunks. You have to buy.
I mean, like you have to pay like that initial amount to buy the stock, and then if you want to sell it because it made $10 or whatever, you still have to pay that to sell it.
The commission you're always paying on the trade, but remember a lot of these day traders are trading thousands of shares at a time. So when you're trading 1,000 shares, something that's worth several $100,000 or even a few $1,000s, the $6.99 that you're paying is de minimis based on how much you've made off of the increase in the price of the stock.
They don't get like some kind of a deal? Like they don't...
Not necessarily, no. The brokerage companies probably have arrangements, but most of the individual day traders, no. They would just pay the same that we pay. Yeah. I think our time is up, unfortunately. But thank you all for staying. Email me if you have other questions.